If you're selling life insurance, one of the options that you should be familiar with is your ability to bind coverage when you take a life insurance application on a prospect. And this is referred to as a temporary insurance agreement, usually a 1 or 2 page document that's part of every application packet. And this is your way of providing the applicant with temporary conditional insurance coverage as soon as you take the application and throughout the entire underwriting process. Because in the unfortunate event that your client dies during the processing of their life insurance application, the death benefit would be paid to the beneficiary. Hi, I'm Dave Donchie with Leisure Worden & Terry. Thanks for joining. And today I'm going to give you a general overview on temporary insurance agreements so that you have a good idea as to how these work and why you should consider completing one on the next life insurance application that you submit. So why don't we get started? I'm going to go to the board and share my screen. Okay, temporary insurance agreements may also be known as conditional coverage or limited insurance agreements, but essentially it's the same thing. Carriers will have coverage limitations. Typically, you'll find $1 million is the most you can bind, but there are some carriers that'll lower that to $500,000. The key to recognize is if your client is, say, applying for $2 million and they execute the temporary insurance agreement, the most the carrier would be on the hook for is $1 million. Of course, a prepayment is required to bind the insurance protection during the underwriting process. The applicant must submit a modal premium with the application, and it has to be done when the application is sent in. So if you send your application in and a week later you decide to send in the premium payment, that will not bind the temporary insurance agreement and the carrier would refund the money. So the key is to get the money in when the application is submitted. There are age limitations. On the lower end, usually at least 2 weeks, and on the upper end, age 70. So for example, if you have a client that's age 75, they're not generally going to be able to bind temporary insurance during the underwriting process. Temporary insurance agreements are also subject to maximum coverage. So if you submit a really large case, say $20 or $25 million, you're not going to be able to bind the coverage. Most carriers will cap the amount of coverage at $5 million or $10 million that's being submitted in order to get temporary insurance coverage, which again may be limited to just $1 million during the underwriting process. This will vary by carrier, but there is a maximum amount that you can submit. Every temporary insurance agreement has a knockout medical questions section, and these questions will look something like this. One question may read, have you been admitted to or confined to a hospital within the last 24 months? And some carriers might say within the last 90 days. Or was it recommended to have a surgical procedure that wasn't done yet? If the answer to that question is yes, your client will not be eligible for temporary insurance. Another question is, has your client ever been diagnosed or treated for heart disease or cancer, diabetes, stroke, or drugs or alcohol? The answer again to that is yes. You can still submit the application, but they would not be eligible for temporary insurance agreement. And finally, if they've ever been declined, again, you cannot submit a temporary insurance agreement on them, but you can still submit the application. Every temporary insurance agreement has a start date, and it's going to vary by carrier, but the agreements are going to read something like this. The start date might be the date of the signed temporary insurance agreement. Another possible start date is when the carrier receives the funds with the application and those funds are honored by the bank. Another carrier may say that after the application and the exam are received by them, unless the proposed insured dies from an accident prior to the exam being completed, that's when the temporary insurance agreement will start. So again, it's going to vary by carrier, but this is a pretty good idea as to what the start date looks like. And finally, every temporary insurance agreement has an end date. And again, that will vary too, but it'll look something like this. It may be when a policy is issued as applied or possibly other than as applied. Maybe when a policy is actually delivered to the owner and all the amendments and delivery requirements have been completed. It could be the date the carrier mails a decline letter. That would stop the temporary insurance agreement. Or it could be the date the carrier mails an unable to approve at the premium amount quoted letter. So if those letters are sent, that is the date that the temporary insurance agreement would terminate. And finally, it might be after, say, 60 or 90 days has lapsed. If you can't get that case underwritten in a timely manner, the temporary insurance agreement might eventually end. So this should give you a good general overview on what temporary insurance looks like when you submit a life insurance application on your prospect. And importantly, the decision to do so should come as a result of a conversation that you have with each of your life insurance applicants. For more information on temporary insurance agreements, contact any of the LWT salespeople. We'd be more than happy to walk you through and tell you a bit more. Thanks for joining. I'm Dave Donchie for Leisure, Worden & Terry.